How does Bitcoin stack up against gold and money as a means to store and protect your wealth over the long term? Are you looking to diversify your investment portfolio and considering adding a store of value asset to your holdings? In this video, we will dive deep into the debate of gold versus money versus Bitcoin as stores of values. We'll explore the similarities, differences, and potential advantages of each asset, as well as examine their historical performance. Welcome to Knowledge Pilot. Let's first define what we mean by a store of value. A store of value is an asset that can maintain its purchasing power or value over time, typically over long periods, thus preserving its worth or utility as a means of storing wealth. In other words, a store of value is an asset that can be stored, saved, and retrieved later, with the expectation that its value will remain relatively stable or even appreciate, making it a reliable source of future purchasing power. Examples of store of value include precious metals, real estate, stocks, bonds, and certain currencies. Could Bitcoin take gold's place? Gold has been considered a store of value for centuries due to its rarity, durability, and universal acceptance. It is a finite resource that cannot be created or destroyed, and it has been used as a medium of exchange and a store of value throughout history. Gold is also widely accepted around the world and is not subject to the same geopolitical risks as other currencies. Bitcoin, on the other hand, is a relatively new technology that is designed to be a decentralized digital currency. It operates on a blockchain, which is a decentralized ledger that records all Bitcoin transactions. Like gold, Bitcoin is also finite in supply, with a total supply limit of 21 million Bitcoins. Bitcoin's limited supply and decentralized nature makes it an attractive alternative to traditional currencies, and some argue that it has the potential to replace gold as a store of value. However, there are also some differences between gold and Bitcoin that makes it difficult to directly compare the two. While gold has a long history of being widely accepted and recognized as a store of value, Bitcoin is still a relatively new and untested technology. Bitcoin is also subject to significant volatility and market fluctuations, which can make it a risky investment for some. Gold and Bitcoin are limited. Both gold and Bitcoin are limited in supply, but they achieve this limitation through different mechanisms. The total supply of Bitcoin is limited to 21 million as a deliberate design choice made by its creator Satoshi Nakamoto. This limit is hard-coded into the Bitcoin protocol, which is the underlying technology that governs how Bitcoin transactions are processed and verified. The decision to cap the supply of Bitcoin was made for several reasons. First, it helps to create scarcity and maintain the value of the currency over time. If there were an unlimited supply of Bitcoin, its value would likely decline as more and more coins were introduced into circulation. Second, the limit on the supply of Bitcoin is designed to prevent inflation. Unlike traditional currencies, which can be printed and devalued by governments, the supply of Bitcoin is fixed and cannot be increased beyond the predetermined limit. This means that the value of Bitcoin is not subject to the same inflationary pressures as other currencies. Overall, the decision to cap the supply of Bitcoin at 21 million was made to create a currency that is scarce, inflation-resistant, and has a predictable monetary policy. Gold is limited in supply by its physical scarcity. The amount of gold in the world is finite, and it is difficult and expensive to mine and extract more. This means that the supply of gold grows relatively slowly over time, making it a relatively scarce asset. Money can also be a store of value. Money is simply a medium of exchange that is widely accepted in transactions for goods and services. It serves as a unit of account, a store of value, and a standard of deferred payment. Money can take many forms, such as physical cash, bank deposits, and digital currencies. As a store of value, money can be held and used to preserve wealth over time. When people store their wealth in money, they expect that it will maintain its value and purchasing power in the future, similar to how gold does, along with other assets like real estate and stocks. However, not all forms of money are equally good stores of value. Some currencies, like those that are subject to high inflation rates or unstable political conditions, can rapidly lose value and erode the purchasing power of those who hold them. In contrast, other currencies, like those with stable economic and political systems, may be more reliable stores of value. A lesson from history. One example from history of when money was not a good store of value is the hyperinflation that occurred in Germany in the early 1920s. After the First World War, Germany was required to pay significant reparations to the Allied powers, which led to a severe economic crisis. The German government began printing large amounts of money to pay these reparations, which led to hyperinflation and a rapid decline in the value of the German mark. At the height of the crisis, prices in Germany doubled every 2 days, and people had to carry wheelbarrows full of money just to buy basic goods like bread. the value of the German mark became so unstable that people began using other currencies, like the US dollar and the Swiss franc, to conduct transactions. This experience showed that even a once relatively stable currency like the German mark could quickly lose its value under certain economic and political conditions, highlighting the importance of having a reliable store of value to protect against inflation and other economic risks. Okay then, what about Bitcoin? Could Bitcoin be considered a store of value? Yes, but Bitcoin's effectiveness as a store of value depends on a variety of factors. On the plus side, Bitcoin is like gold and other assets that are commonly used as a store of value, in that it is scarce and has a finite supply. This scarcity is built into the Bitcoin protocol, which as mentioned earlier, limits the total supply of Bitcoin to 21 million coins. Bitcoin is also less susceptible to geopolitical risks because it is decentralized. This means that it is not controlled by any single entity or government. However, on the negative side, Bitcoin is also subject to significant volatility and market fluctuations, which can make it a risky investment for some. The value of Bitcoin can be heavily influenced by a variety of factors, including global economic conditions, regulatory changes, and shifts in investor sentiment. Furthermore, unlike other traditional stores of value, Bitcoin is not widely accepted as a means of payment for goods and services. While this may change in the future as Bitcoin adoption increases, it currently limits its usefulness as a store of value. The case for Bitcoin as a store of value. One example of why Bitcoin could be better than money as a store of value is its deflationary nature. As mentioned earlier, the total supply of Bitcoin is limited to 21 million coins, which means that its supply is fixed and cannot be expanded beyond this limit. This makes Bitcoin immune to the inflationary pressures that can impact traditional fiat currencies like the US dollar, which can lose value over time due to factors like government monetary policy or changes in the global economy. In addition, Bitcoin is designed to be a censorship-resistant and borderless currency. This means that it can be used to send and receive value anywhere in the world without being subject to the same restrictions and regulations that can impact traditional currencies. This makes it a potentially valuable store of value for people who live in countries with unstable political or economic conditions, or for those who want to protect their wealth from confiscation or seizure by governments. Finally, Bitcoin is decentralized, which means that it is not controlled by any single entity or government. This gives users greater control over their wealth and reduces the risk of centralized control, manipulation, or seizure. Overall, these factors make Bitcoin an attractive store of value for some investors who are looking for an alternative to traditional currencies. However, it's important to note that Bitcoin is also subject to significant volatility and market fluctuations, which can make it a risky investment for some. We're going to wrap things up here for today. Please note that the content of this video does not in any way constitute financial advice. Investors should carefully consider the risks and benefits of investing in Bitcoin before making any investment decisions. We hope you liked this video. If you want more, check out our other videos on the screen. Thank you for watching.